The tech sector faced a sharp decline on April 3, 2025, following the unexpected rollout of new tariffs by former President Donald Trump, who recently returned to office. The announcement sent shockwaves through global markets, with major technology companies, particularly Apple, bearing the brunt of the sell-off. The tariffs, targeting Chinese-manufactured electronics and semiconductors, have reignited fears of a renewed U.S.-China trade war, leading to heightened market volatility. We provide a comprehensive analysis of the market reaction, the implications of the new tariffs, and the broader economic consequences for the tech industry, as well as examining the key drivers behind the sell-off, the companies most affected, and potential long-term repercussions for investors and supply chains. The Dow Jones Industrial Average, DJIA, and Nasdaq Composite both opened lower, with the tech-heavy Nasdaq suffering the steepest losses, down 3.2% by midday. The S&P 500's technology sector dropped 2.8%, marking its worst single-day decline since early 2024. Leading the downturn was Apple, AAPL, which fell 5.4%, its largest intraday drop in over a year. Other major tech players, including Nvidia, NVDA, Microsoft, MSFT, and Alphabet, GOOGL, also saw declines between 2 to 4%. Semiconductor stocks, heavily reliant on Chinese manufacturing, were hit particularly hard, with Taiwan Semiconductor Manufacturing Company, TSMC, and Qualcomm, QCOM, dropping 6% and 4.5%, respectively. Apple's significant exposure to China made it the most vulnerable to the new tariffs. According to analysts, over 90% of Apple's iPhones, iPads, and MacBooks are assembled in China, and the company relies on Chinese suppliers for critical components. The Trump administration's new tariffs impose a 25% levy on imported electronics, up from the previous 10%, significantly increasing production costs. Analysts at Morgan Stanley estimate that Apple's gross margins could shrink by 2 to 3 percentage points if the tariffs remain in place, potentially forcing price hikes for consumers. Beyond Apple, other tech giants face similar risks. Microsoft and Alphabet, both companies depend on Chinese manufacturing for hardware like servers, cloud infrastructure, and consumer devices, e.g., Surface laptops and Pixel phones. Semiconductor companies, chip makers like Nvidia, AMD, and Intel source materials and packaging from China. The tariffs could disrupt supply chains and delay production. Electric vehicle, EV, makers, Tesla, TSLA, fell 3.8% due to concerns over Chinese battery tariffs. The Trump administration's latest trade measures include a 25% tariff on all Chinese-made electronics, including smartphones, laptops, and semiconductors. Stricter export controls on advanced chip-making equipment to China. New restrictions on Chinese cloud computing firms operating in the U.S. These policies aim to reduce U.S. reliance on Chinese manufacturing and protect domestic industries, but analysts warn they could backfire by increasing consumer prices and disrupting supply chains. The move aligns with Trump's long-standing America First trade policy, which prioritizes domestic manufacturing. However, critics argue that the tariffs could provoke Chinese retaliation, such as restrictions on rare earth minerals, critical for tech manufacturing, and may accelerate decoupling between U.S. and Chinese tech sectors, leading to higher costs and slower innovation. As well risk alienating allies like Taiwan and South Korea, whose semiconductor industries are caught in the crossfire. Beijing has historically responded to U.S. tariffs with countermeasures. Possible actions such as targeting U.S. agricultural exports, as seen in the 2018 to 2019 trade war. Limiting exports of critical materials like gallium and germanium, used in chip making. And imposing stricter regulations on U.S. tech firms operating in China, e.g., Apple, Tesla, Microsoft. Many tech firms had already begun shifting production out of China due to previous trade tensions. The new tariffs could accelerate this trend, with companies relocating to Vietnam, a growing hub for electronics assembly. India, where Apple has expanded iPhone production. Mexico, benefiting from USMCA trade benefits. If companies pass tariff costs onto consumers, prices for smartphones, laptops, and other electronics could rise by 5 to 10%. This may slow demand, particularly in price-sensitive markets. Trade restrictions could hinder collaboration between U.S. and Chinese tech firms, potentially slowing advancements in artificial intelligence, AI, where Chinese researchers play a key role. 5G and telecom infrastructure. Huawei's exclusion from Western markets already disrupted rollout plans. Semiconductor development. China controls key steps in the supply chain. However, experts caution that full decoupling from China is nearly impossible due to its dominance in rare earth metals and advanced manufacturing. The uncertainty surrounding this new trade policies may lead to increased market volatility, particularly for tech stocks, lower valuations for firms with heavy China exposure, and a shift toward defensive stocks, e.g., utilities, healthcare, as investors seek stability. The April 2025 tech stock sell-off underscores the fragility of global supply chains and the risks of escalating U.S.-China trade tensions. While the Trump administration's tariffs aim to bolster domestic manufacturing, the immediate consequences, plunging stock prices, higher consumer costs, and potential Chinese retaliation, highlight the challenges ahead. As the situation evolves, businesses and policymakers must balance economic nationalism with the realities of a deeply interconnected global tech ecosystem. One thing is certain, the tech industry is entering a new period of uncertainty, with far-reaching implications for markets and consumers alike.